now I'm going to come into my projections for the coming year in the 5 major markets. This again is going to be different. A lot of you that are members have seen my big picture analysis. People write to me and keep asking me to do more and more of it. So I decided to bring that big picture analysis into this show and do the 5 major markets that way, and then you can get a good sense for my reasoning about what I think is going to happen in markets. And I think you'll learn a lot about that, about cycle analysis. If you're new to cyclical analysis, cycle analysis, I'm really, I believe, one of the experts in it. And I wrote a workshop on it with 20 videos that we have in our website that you could see, and you can go look at an informational video on that by looking at Cycle Analysis Workshop. You'll learn just a ton about market cycles, and that's what I'm going to bring you right now as we switch over into the charts. Now, I didn't really want to show you the S&P 500, so that was jumping out before I want to get to that. So you could get a little peek at that. I do want to show you light crude. Now, this is a monthly chart of light crude. And what I have in here, and you'll note that I have this gray area right there, and that I have the notes in here about the year colored in the background, and that gives you an idea about whether I think there's going to be a directional change or a big change. And gray means that I do not expect a big change in the coming year in light crude. And I'm going to tell you now about the rhythms in the market so you understand them. So on the bottom is cycle brackets. And what these are just drawing tools. They help us understand the money flow, the movement in and out of markets. We use support and resistances in order to tell us how it's acting relative to those phases, the rally phases, the peaking phases, the corrective phases, the bottoming phases. We use that information to help us, and then we also use momentum. And this is our momentum indicator that you could see right in here. And you could see momentum in here is just not doing anything, just moving sideways right in there. This is a monthly chart of light crude. And what this says to me for the coming year is that we are entering into this period here. This is the final quarter of time in this cycle. That when you look at the final 25% of the time period in the length in the cycle measured from low to low, you will see that every single one of them coming down into 2015, 2016, this is in 2018, this is in 2018, this is in 17, and here we are in 19. All of this is a period of downside risk. So for 2019, oil was up 28%. It was a pretty good gain. For 2020, cycle patterns suggest an early peak. In other words, right in here. Maybe it pops out slightly above that triangle that we see in there right now. But then mid-year, it points to a decline down to support, to this level here, approaching $50. Then a rally again into late year. So you can see that we're trading here, and the pattern suggests a movement down and then a movement up to somewhere probably plus or minus a couple percent. Nothing big, a suggested small change. Momentum is not established, and it's because, well, there's not anything going on of significance as we get into this triangular shape, or pennant as they call it. So we're looking for a decline in here near 50, and then another rally back, as probably what happens is we hear about OPEC cheating, or we hear about supply-demand situation, which is still very big on the supply side, remains so, and the prices begin to chop around and move down. So outside of some little upside potential here early in the year, we see it then moving to the downside. And then a rebound. Small change on the year, we'll look for a range of about 50 to the mid 60s in light crude for the year. All right, so now we're going to move into the dollar, DXY. And you can see this great big inverted head and shoulders in there, and a bunch of colored phasing, which I'm going to explain to you. Note the inverted head and shoulders right here, the breakout, and coming up here and tagging the measurement, and then failing here or stopping at this 78.6%. Notice also the large harmonic families. The big low right over here, the big low right over here, and yes, a big low right over here. What does that mean when you look at it? Well, let's get a little closer look right here, and you will see that our note, which is highlighted in red, suggests that there will be weakness. And this period that we're talking about in 2020, where we see multiple cycle peaks and a decline into 2021, mid-2021. Momentum is failing in here right now, but still not giving you anything of significance. So with a 5.6% gain on the year in 2019, we are now looking for a decline all the way into 2021. That are these nested bottoms right in here. So what does nesting bottoms mean? Let's take a little deeper look at this right here. And you could see that there were three nested bottoms coming right in here, and that pushed it down very significantly. There were three nested bottoms coming right in here, and the decline was not as significant. It fell from 84.70 down to about 78. That's still a decline of over 6 points, or about 8% in the dollar, and we could see here we are into this period of nesting, 3 cycles coming down. That's why we see multiple cycles peaking in this year and a sizable decline into 2021. If this analysis is correct, this is pointing to a period of the precious metals having a pretty good time of it as they move inversely to the dollar most of the time. Most of the time, the correlation is inverse. The dollar to the metals or to gold and silver. So that points to a period, and we're looking for a weaker dollar, and we're going to call for a decline in the dollar in this coming year and into mid-2021, which we think could be significant. You see it pointing down here to that decline, that low right over there. That's at about 88.20. We don't know if it'll make it to 88.20 this year. It probably makes it to next year, and let me tell you, the risk is it will fall much sharper than that. The decline in here of the dollar may very well be a signal of a potential of very low interest rates, because money would be moving out of the dollar based on policy changes. And we're going to talk about that as we move forward and we look at the bond market in just a moment. But we're going to now move over into the gold market. That's / GC. Of course, it's GLD in the ETF. And now we're going to look again at these cycle harmonic rhythms in here. And the reason I have this in the bottom here is because it's hardly a place that I could find a space. 2019, gold's up about 17.8%. We expected that. Gold fell a little bit short of our upward projection. We thought it would make it to 1600. It didn't quite make it, but you could see. But we did pretty well in gold on that call. The 2020 gold pattern suggests a rise near 1600 again, then a correction into Q3, followed by another surge into 2021. So there you are, that inverse correlation in the dollar. We're looking for a 10 to 15% gain for 2020 and up strongly potentially into the following year. Momentum is strong on the upside, as we see right over here. And what we see also is that silver target for the year is at around $22. So I wanted to put that in there also. Let's blow this out a little bit more, because one of the things I showed when I did my last big picture analysis was this triangular shape right over here. Now, cyclically, it comes at almost the same spot that this does right over here. And that then brought a big advance. You can see right there after that and we're getting a breakout right over there going on. So this could be the beginning of this move that we believe is up to about 1600 or a little bit better than that. And then this decline right over here suggests that it's going to come down into about the summer, or maybe somewhere July, August, after a rally, and give some area here of decline. But we think that would be a buying opportunity, and then this rally going up into 2021. So it's kind of a bigger picture we're showing you, and our expectation is for this rise up to 1600 or better, then the correction into, we'll say, potentially into the beginning of Q3 right over there. Overall, we expect that it will be another year where gold gains, and again, we'll give it 10 to 15% on the upside for the year. So now let's talk about the Treasury market, because when we talk about the dollar potentially going down for some extended period of time, then we're actually going to want to say that that's not good. What it reflects is that interest rates probably could be going down again. Now, look at this remarkable information in here as we look at the, let me just get a little closer look for you to see right here. I want to get this laid out for you well. So what we're looking for is, remember, this is gray. We're looking for kind of a neutral market for the bond market and interest rates. Now, what we're looking for is a decline first in the bond market. And that takes you into somewhere between Feb and April for a low for the bond market, or the high in yields for the year. That down to this level right over here equals about 2.1% yield. That's reasonable. It could go to as high as 2.4 if this gets a bigger dip to the next support. But the bond market is in a decline. Now, you see that 11 up there? That was an 11-month peak. So if that's an 11-month peak, we are 14 months off of this low. You can see that very clearly. From this 19-month low, it rallied 11 and fell 3 so far, so that's 14 months. I want you to note the cyclical action in here. 16 months, 18, 15, 18, 19, 19. All of those, a magnificent rhythm in there, and now we're only 14. That says that this decline is likely to be, if it's average, between 2 and 4 months on the downside. Hence February to April as the projected low in the bond market for the year, with yields 2.1 to 2.4%. Then we look like we're going to have a big upside move. This translation will be very positive. In other words, where this bottom comes will be much higher than this. That says that this peak, there's better than a 75% probability that this peak in bonds will be taken out, or the low right over here, which happened to make 1.4%, 1.44 in yields, will likely be taken out. We believe that there's a potential crisis of sub 1% yields coming in 10-year in this rally, which takes you 2020, 2021. That, of course, would potentially bring a upside move in the gold market, a downside move in the dollar market. But also it means that if there's a crisis, the stock market is going to get hit, and hit in some kind of a big way. And if that happens and we get into our next deflationary period, then the gold rally won't be able to hold up that well, and gold will get sold very hard also in there, because when deflation hits, then investors, public, they need money, they need cash, so they sell everything. And that's why I believe that gold's best time of it will probably be in 2020, maybe not be able to get into 2021, and a very strong possibility for record low yields here in the U.S. coming into late 2020, 2021. The question is, what will the crisis be? What will bring that you can get that kind of a low? And you can see here, note the positive correlation, the positive configuration here, where this closed well above where it began. It brought that huge rally right over there. Here is another one right in here. 18 months brought the huge rally after that. So positive, new high, positive, new high, positive, and then new high or new low in yields coming. That speaks to something out there that is not very pleasant out there. For 2019, the yields actually fell for the 10-year from 260 to 1.9, where we are now. The 2020 pattern suggests a drop in treasuries into Q2 and then a sharp rise beginning for record low rates in 2020, 2021. Momentum right now positive and stalling. It's probably going to be giving you a downward tick in momentum for a brief period of time, and then be moving sharply to the upside. We would say that sometime around April, May would be the time that we would expect that the bond market would beginning to move up in some significant period of time. So that is the big picture and the bigger analysis in the bond market. You could see the beautiful rhythms there in bonds. They are spectacular. And that shows you the money flow and how interest rates do move up and down in an extraordinarily consistent way. And that consistency, we believe, will continue, and that major cycle peak that you see right there will be taken out in the 10 years, and that means record low rates coming in sometime late 20 or 2021 for the U.S. economy. And what does that speak to? Well, probably crisis. Next thing we're going to look at, or the last thing, is the stock market. Here is the S&P 500 going way back, and there are lots of things that we're going to talk about here as we look at this. This has a little more involved analysis on it that you could see. What we're looking at in 2019 is the S&P 500 now up about 29%. We still have 2 more days to go when I'm recording this. The Dow is up about 22%. The healthcare stocks way down a little bit. Boeing, of course, way down a little bit. The NASDAQ clearly the best, 36% gain, and the Russell up about 22%. That is coming on and strengthening late in the year, but still, as you could see, the laggard in there. And somewhere here, as we get into final stages of the bull market, I think you're going to see the Russell overperform. And then again, this isn't like anything we've seen in the past, so that may not be the case. 2020 cycle patterns suggest a bull peak in 2020 with a major bear market into 2022. The minor monthly cycles, and I'm going to show this to you, point to a corrective period into the second or third quarter, and then a stronger fourth quarter. So that, here's your election year. I think it's going to be weak into the middle of the year and then gain in towards the election time. And that break and that rally, I'll give you some detail on, but the late high could test the highs that we're making now, 3,250 to 3,300 in the S&P 500, before the bear really sinks in. And you can take a peek there on the right. You could see my projections there. And we're looking for a small loss for the year. Nothing really all that significant, but we're going to call for a down year. Momentum is strongly positive, and it has been that way for this entire year. So you can see that strength. Now I'm gonna explain some things in here for you to see, and what I want you to note as I bring this up and look at a little bit more data in here, is you could see the 2022 peak right over here, 2002 peak, and then the bear market. You'll notice in here that there are harmonic families. In other words, this is like music. This is your dominant pattern right in here, and that dominant is 80 months long. Your intermediate pattern right over here is 40 months long, and your minor cycle pattern in here is about 20 months long. So that 40-month long one is, when you look at that, that's about 3.3 years. So it's about 6.7 years on the bigger cycle. And those are different than we had looking back decades ago, where you had an average of about 53 months that was going on. And now you have this new rhythm that's going on in this period of government invasiveness, and Fed central bank invasiveness has changed things a bit. But you still could see the beautiful rhythms in here. Now, here's your 2002 peak, and note 3 cycles bottoming in here. Each of these put downside momentum right there, downside momentum, and you had the big break. The same thing right in here, and you'll notice that it's the 4th minor cycle right there that tends to bring the biggest declines. And so the reason there are 3 stars there is because it shows you 3 cycles bottoming right there. There was 1 little cycle bottoming here and 2 here. When there's one little cycle bottoming on the minor one, you don't get much decline, and when there's 2 of them, you get a little more decline, and when there's 3 of them, you get a bigger decline. So here you could see the rally here into 2016 and the mini bear market right there. That was down about 17%. And comes down right over here, and then you had 3 cycles bottoming right here. So that's the lows that we made here in 2016. So while some analysts, as I said in the beginning of the show, talk about this as being a bear market low, and I do believe with the 20% decline it was a mini bear, when you look at these cycles, it comes right in the middle here. So there's 2 cycles that were coming down here. It's not the 3 cycles or the really big decline that's due when they all come down right over here. And that is yet to come. And that comes out to bottom in 2022. So we have a lot of bear market potentially ahead of us. You'll notice this bear market over here where it peaked and then broke down, that was a pretty average decline of some 18 months on the downside, depending where you measure it. This is a pretty normal decline in here of, again, over a year on the downside. So if you're going to get over a year on the downside, that means you're going to get a lot of choppy market or topping market as it extends out in here. So now let's again talk about what we're thinking about for the year. Now, if we're in this period of these cycles, let me just blow this out again for a second for you to see, of these cycles coming down right in here. Now, this is the highlighted area, this red area. That's this 3rd minor cycle declining right in there. So you see where the 3rd one declined right in here, you got a decline of about 6%. Not that much, right? You got this one right over here, you got a decline of about 11%. So what we're projecting is that there's a decline coming here into the corrective period of Q2, maybe Q3, which is likely to get you this dip of 8 to 12% on the downside. So that projects to 29.90 in the S&P down to about 28.60 right over there. So the support right over here is 26.93. That would be a lot deeper, right? So you see we don't have it projected that low. But still, we expect that there will be some 8 to 12% decline as we look at this for the coming year, and then another rally back. So you can see that fib target zone that we had there, momentum moving up strongly and getting to the bottom of this fib target zone right over here, which lines up at about 32.50. The weekly fib target zone goes up to about 3,300. So we think this is going to be rolling over and give you that correction into this Q2 or Q3 period over here. Depending if it shortens up and it wants to, move up into election time, it could bottom in June, July. It could bottom August, September, depending on what the environment is. And again, we're only looking for about 8 to 12% pullback into that mid-year period. And then comes the rebound into the end of the year. Hence, we don't think it's going to be a very big change for the year, though slightly down, not being able to recover this decline in here, which, again, 8 to 12%. But if it was 20%, it wouldn't shock me if that was the case. And then rebounding, and then sometime here in late 2020 or the beginning of 2021, giving it up, and then the full-fledged bear market coming right in here. Because we think interest rates are going to go to a crisis low in 2021, we think that this peak is likely to occur in 2020 and that we have this extended out too far, but it's pretty hard to extend out in months when you look at this. So again, what we're looking for this year is an early peak in the year, a pullback sometime into mid-year, and then another rally and ending down slightly on the year. That is a look at the stock market. We think it's going to be a tougher year for investors, but again, no washout for them. And those that persevere and wait for buying opportunities, it's probably going to be there. Those that are looking for opportunities for trading, I really believe this is going to be a much, much better year coming up for the trading world out there that have had such a tough time for it in the coming year.